Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, sitting next to Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. If this is the first time you are tuning in with the both of us, first of all, welcome. Second of all, make sure you check out all the content that we put out there on the internet. I tweet about stocks at Focused Compound on Twitter. Jeff writes about stocks at focusedcompounding.com. We manage capital at Focused Compounding Capital Management, and we upload a ton of podcasts and investing videos through YouTube, and then of course the podcast app on your iOS device or Android. So check out all of our content, 300 episodes. So that's pretty wild. We're like, 4 years into this, 3.5, something like that. I think it was the end of 2017. So that's pretty wild. So thank you so much for being with us on the journey. So in today's podcast, we are going to continue our series talking about Buffett's early investments. We are using Capital Allocation. Our friend Jacob McDonough so graciously gave us a PDF copy of his book to go over and get the figures of Buffett's early investments with Berkshire. Check out the video last week. We actually went through the process of him actually taking control of Berkshire. And in today's podcast, we are going to be talking about National Indemnity. I think this was probably one of the most important acquisitions that he made. One of the most important early acquisitions with Berkshire. Would you agree?
Yeah, this is Berkshire's most important acquisition.
Why would you say that? And I'll tell you why I think that.
Well, this was the move into insurance and away from textiles.
That's what I thought. It was his first investment away from a failing textile mill and into something that is really, when I think Berkshire, I think float, I think insurance. Mm-hmm. And this was the first step into that. And, we could go through, if you're watching on YouTube, I did redact certain things because the last thing I want is for you not to buy Jacob's book.
Yeah,
the book is in the description. So go support him, Amazon.com. It's one of Jeff's favorite books on Berkshire. I love it as well, too. So definitely go check it out. But so 1967, that was the year that they acquired the company. Mm-hmm. And in Berkshire's annual report, Buffett wrote, in March 1967, the company purchased for $8.5 million over 99% of the outstanding stock of National Indemnity Company and 100% of the outstanding stock of National Fire and Marine Insurance Company, both headquartered in Omaha, Nebraska.
Very close to his office, actually.
Buffett actually knew the CEO. He was sort of I guess you could say one of those high society in Omaha. And I believe that Buffett actually talked to Jack Ringwalt once about investing in Buffett's partnership.
Right.
But supposedly, now I guess
there's
both of them,
there's
conflicting stories. Jack says that Buffett wanted a $50,000 minimum investment, but Buffett was taking way less than $50,000 at the time. And as the legend goes, Jack Ringwalt was supposedly like, I'm not going to give $50,000 to you, you kids, squirm, get out of here. And I guess Buffett's secrecy also really put Jack off as well. That's what they said in the Snowball anyways.
Yeah.
But it was interesting though. So hearing about how he actually purchased this company, Buffett knew somebody else that knew Jack. And Buffett asked this friend if Jack would ever be willing to sell the company. And the friend told Buffett that about once per year, he usually gets cold feet where he thinks about selling the business. He's like, once per year for about 15 minutes. So Buffett told him, next time he starts having those thoughts, call me and we'll get a deal done. So I guess Jack and this guy, I forget his name, they're out at dinner. And Jack said that the cold weather was bothering him in Omaha or something along those lines. And he was talking about selling National Indemnity. And he said, you should call Buffett. And this guy called Buffett. Jack was about to go to Florida, I believe, for a vacation.
Okay.
And this guy was going to try setting up a meeting for them like the next day or something. And Buffett was like, how about this afternoon? And they met, they talked. And I think Jack had like 3 stipulations that he wanted. He didn't want any employee to be fired.
Right.
That was one.
Yeah.
He wanted, I think, $15 more than Buffett originally appraised the company for per share. Buffett still did that. And then there was another one, which I can't remember. Do you remember?
From the Snowball, I remember that he said, well, you probably want me to sell you my agencies.
Yeah,
right?
that's what
And he
I
said-
wouldn't even dream of
And he
it.
said, no, which is how they source the business and stuff. And then he, and are almost always sold with the insurance company. And then he also said, I'm sure you'd want an audit or something. And allegedly Buffett said, audits, those are the worst kind of financials.
I hate audited financials. Yeah.
Yeah. So whatever he wanted to make the deal happen. Yep.
So basically it worked, and he did not want Jack to get cold feet, and he did, I believe, actually get cold feet, but they said that he's a man of his word, and he went through with it. And he bought stock in Berkshire Hathaway too.
Yeah, apparently he used the money that he got to buy stock.
Yeah, so obviously that played out well for him. But Jack continued to run the company. So this is like Buffett 2.0 in like the best fashion ever. So he has a great business that he really likes, and the CEO that sold out to him stayed on and continued to run the business.
Yeah, I forget how long. I don't know if it tells you in the book, but 10 or 12 years later or so, there was someone else running it, but he did run it for a while. Yeah.
So I have here that the company had 19.4 million in float around the time of the acquisition.
Okay.
So obviously this term float is talked about a lot in the investor community because of what Buffett has been able to do with it. I mean, you actually sent me an article from Bloomberg last week when he was going to invest $9 billion in the Texas grid for like electricity or natural gas.
He wants to, yeah.
Yeah, and he's trying to get a guaranteed rate of like 9.25% or something like that. And I think my response to you was, for a basically free money that he has with the float, that's like a pretty crazy spread, but very Buffett-esque. But so the business, this was the first step that Buffett went with capital allocation to really get away from a failing textile mill. So, and we have some of the figures up here right now. Is there anything that sticks out to you? This is from 1955 to 1965, and the acquisition, like I said, was in 1967.
So National Indemnity, I think the things that stood out to me about it were, you have the, the premium numbers, the revenue numbers.
Yeah. Net income, so underwriting gain, investment gain. Let's see where we have the loss ratio.
Yeah, the loss ratio is fine. I mean, we could get into the interest rates at the time and things like that. It was okay. It was fine. But what is interesting is the amount of premiums that they were writing versus their equity and things like that. And Jacob gets into more detail about this later. But as being part of Berkshire, it was easier to handle large amounts of premiums versus equity. Berkshire really, as a company, when you count the entire company together, not just the insurance parts of it, because the other parts of the company kind of gave strength to the insurance companies over time, rarely wrote premiums in excess of 100% of equity, usually less, which is not very aggressive at all for an insurance company. But it allowed the insurance companies to be pretty aggressive in how much premiums they were writing.
What I like what Jack said was that there's no such thing as like bad risk taking, it's just bad prices. And I really think that is sort of like the quintessential example of the type of insurance that they would write and stuff like that. And I mean, and even Buffett to this day too. I mean, everything he does is all based around like handicapping.
Yeah. So National Indemnity is different from something like Geico. Did not have a direct business, worked through brokers, and did certain special risks and things like they talk about in the Snowball. They insured, they insured all sorts. They would insure almost anything. But a significant part when Berkshire got into it would have been auto, I think. Although I think they also did taxi and some different kinds of auto. So some different like non-standard and special stuff with auto. But they mentioned in the Snowball doing contests and things like that, right? Like, finding things that are hidden,
Yeah. And we were talking in the car on the way over. My favorite one that they did was on the bootlegger. I guess someone died and his wife wanted to take the capital out of the checking account or something along those lines. And you would have had to have waited 7 years. And what Jack did was he went to this guy's lawyer, and basically he was part of the deal. And he's like, well, if he's going to source the deal or put his capital in it, I'm sure this bootlegger is actually dead, because the lawyer couldn't say whether he was or not because of client attorney privilege.
Yeah. So in that case, it was it that the bank wanted to allow the withdrawal and be insured against the possibility that he'd come back?
I think so. Yeah. That's what it was.
To release the funds. Yeah. So, strange risks like that. You can see in directories of insurance companies still to this day that National Indemnity is listed under a bunch of odd risks. That they sort them by what kinds of things that they'll cover. And National Indemnity shows up a lot under unusual sorts of things that, there's only a few other companies that write it.
Mm-hmm. So in 1965, the company had $883,000 in net income. And as I did say, he paid, what did I say? It was $8.5 million. So call it, 10 times earnings for this company.
Right. But he has a very interesting way of looking at it, which is that it doesn't matter what the book value of the company is. That's not part of the price, I should say. Basically, his view of it, Buffett's, was that if I'm giving you, let's say your book value is $5 million, I'm giving you $5 million, that is just swapping my assets. I'm giving you $5 million in cash to put, then it goes right back into bonds and stocks, which I would own anyway, because now I direct the investment. So it's only the goodwill portion that matters. And so that's the part he has to assess. And I think that's a very smart way of thinking about it.
Mm-hmm. If you look at the float from 1955 to 1965, it grew from 1.9 million to 13.3 million. It's 21% CAGR over those 10 years.
Yeah. Yeah. It had pretty good underwriting results, not like amazing underwriting profits, but it was able to write at basically costless to Berkshire over time while growing a lot, and that was a big part of it. The growth part of it was very big compared to other parts of Berkshire. The insurance business grew a lot. You can see that because Berkshire as a whole was only growing by about that amount too. So it grew in line with Berkshire basically in terms of their growth in their book value and their stock price and all that.
What are the things that insurance companies, I guess just from your experience, and we should do more podcasts on insurance companies because that's probably one of the most common questions I get asked is if it's not banks, it's insurance companies. What are some things that they do that like allow it to be like the profitable underwriting and stuff like that? What matters in insurance to you?
So a few things. One, they talk about it a little in the book. Berkshire had lots of problems in insurance, and they get into some of the ones. Good people skills, understanding. So for instance, a lot of times people talk about fronting arrangements and things like that. You have to be careful of things that have to do with all of how you source the business that you get. So this is not a direct business. So when I talk about direct business, like half of I don't know if it's half anymore, but part of Progressive business is direct. That's the ads you see that say, call us up, go to our website. And then part of it is indirect. It's distributed through agents. So for car insurance, it's pretty simple in terms of what you're figuring out. So it's kind of like, are they right? It's just like a loan. Is it a conforming mortgage or not? And evaluating that. But for things like you can imagine with National Indemnity, where they're doing all sorts of different risks, it becomes a bigger issue if the agent is misrepresenting things to you. And sometimes you have people, which I mentioned with the agency stuff, who can bind you to certain risks and things without you being able to stop them necessarily from writing business that quickly. There's fraud risks. I invest in some things that had success, and they had very big losses from fraud. Basically being scammed was their claim is what happened. I don't know if that's exactly what happened, but they probably thought they were doing something relatively low risk, and it turned out to be very high risk. And that's because the incentives for some people are to make a lot of money from that. So those are important parts of it. Growing fairly slowly, having better knowledge of the loss things that we were talking about, avoiding certain businesses that are growing rapidly and following what everyone else is doing. I'd say insurance compared to other things has a higher risks related to fraud and higher risks related to who's bringing you business. Berkshire ran into some of those. And then there's also things of watching trends to understand what trends are happening. So I mentioned before, like in auto, watching what's happening with phones, if phones are causing different things to happen. With universal insurance in Florida, I mentioned litigation trends. So are juries awarding more money to people? That's a big thing in trucking right now, right? So there have been more very big awards for people who were killed or paralyzed or whatever from accidents involving trucks, which would be very harmful to those companies and might result in some problems with getting insurance for smaller trucking companies and things like that, because there's just a much bigger risk that there'll be a big verdict. Buffett talked about that a lot in the 70s. Social inflation, he talked about it being bigger and bigger awards from juries and things like that. So you have to watch those sorts of trends and be realistic about them. You know, the quote from National Indemnity, Jack Ringwald, basically that there's no bad risks, it's just bad prices.
Mm-hmm.
Yeah.
So then Buffett comes in and Jack continues to run the business. And in the snowball, they talked about he was paid very well to do that.
Mm-hmm.
How did the business just grow so much from there?
Well, Berkshire tried to grow all of its insurance businesses, and National Indemnity was successful in growing. I mean, I don't know the details of how it did, but like I said, it used brokers. They could place some unusual risks with it. Once it's successful, you can get more business, once you can grow your capital. Berkshire had other sources of capital to rely on, so that it's not necessarily good or bad to have an insurance company in other businesses, but what it does do is smooth things out. So Berkshire being in other businesses does make it easier to put more capital to write more business after a tough time for the industry, and to write less during a good time for the industry and not worry that much about it. So you can kind of react less cyclically with the rest of the industry, if you have a diversified bunch of other businesses, which Berkshire did at that time. And then they went heavier into stocks,
Do you think insurance is like banking in how you like banks to be a little bit more targeted, I guess you could say?
Yeah.
More regional, more specialized.
Mm-hmm. There's sort of two things, I guess, that way. Same with banking and insurance. I think you can have advantages in efficiency. They literally call it efficiency ratio in banks, but distribution advantages and stuff with direct distribution, Progressive, Geico, USA, things like that in insurance. And so low costs that way. But then also you could have advantages in terms of loss experience, understanding what kinds of things you're writing. And I think that's not very useful to have a lot of knowledge of life insurance, because I think it's fairly easy to price. But on the other hand, some of the insurance we're talking about, special risks that we're talking about with these things, are harder to figure out. And it's good to focus in on those specific things.
Is that because it's hard to price, and because you think sometimes the probability of certain events happening is just de minimis?
Yeah, like I'll give you an example. In all companies use insurance. Basically, all companies use insurance for directors and officers. I don't know that Berkshire does. They might be one exception, but everyone else does. And so it protects them against doing some bad things, basically being personally liable for that stuff. And SPACs need them, right? So insurance rates for a SPAC, though, are incredibly high versus other forms of going public and just in general other companies. So if you were taking the average company that needs directors and officers insurance, and you were taking something that was intended to be created as a SPAC from the beginning, if you write at the same rate for the SPAC, you're going to have a really big problem, because the amount of losses that you could have eventually with lawsuits and all that legal expenses you could have to pay doing those things could be really big. So you have to be able to differentiate between those. And there's cycles, right? So like 3 years ago, how much insurance was there even to be written in that entire area? Now it's a pretty big area of insurance. So you have to be aware of where you are in that cycle, whether you should be writing a lot. A lot of times you can write the most at the very time when you shouldn't be, right? Mm-hmm. People need it the most now. Mm-hmm. So yeah.
I was gonna say, do you think the best time to write hurricane insurance is after a hurricane?
It can be, sure. But, with weather things and stuff, to be fair, companies do generally understand that, investors may not understand it as well, but they do understand that's basically random stuff. What's different, and what I worried about with the universal insurance thing is their reinsurance stuff because of low rates and things like that, low returns on assets everywhere. Was that causing reinsurance to be available at more attractive rates than it should have been? In other words, in a normal interest rate environment, a normal environment for stocks and bonds and all that, would people be putting less money into capacity for reinsurance? I think they would be. And so I think prices would be higher. So they kind of benefited in the early 2010s probably from that, which had nothing to do specifically with insurance, with hurricanes. So you have to be careful about that kind of stuff,
Mm-hmm. Yeah, he was talking about this in 2017 I don't know if this it was from a letter to Berkshire shareholders, how they paid $8.6 million in early 1967. With our purchase, we received $6.7 million of tangible net worth that, by the nature of the insurance business, we were able to deploy in marketable securities. It was easy to rearrange the portfolio into securities we would otherwise have owned at Berkshire itself. In effect, we were trading dollars for the net worth portion of the cost.
Yeah, and I say that to people all the time. Buffett was able to do it because he was able to control investment decisions. Only Geico was the only one where he didn't control the investment decisions. But when people ask about that, like with buying some company that's in insurance stuff, you have to look at their portfolio. In a lot of cases, their portfolio might not really be that different and that inferior to yours than how you would invest. The same thing is true when a company has excess cash. Excess cash can mean a lot of things. It could literally mean cash, but I've seen companies where almost all their excess cash is in mutual funds. And people have said, well, why would I want to own something that is just letting cash sit idle? It's not letting it sit idle. A mutual fund owned by a company is probably going to get similar returns to you. You're probably, as an investor, going to get similar returns to a mutual fund. And so same sort of thing here. We talked about investors' title insurance. They're mostly in bonds, but they have a lot of equities. And so if you had a similar portfolio, then you really only need to worry about the goodwill portion. One way of looking at it is that you're allocating much more to bonds, probably, than you would with your own portfolio. But Buffett moved things here from bonds to stocks. And later in his career, he did something where he bought Gen Re. And a big part of that was probably so that he could get out of a lot of stocks and into some bonds because they were heavily in bonds. And so that allowed him to swap out.
So the problem is when you're looking at insurance companies today is that there's only one Warren Buffett. So it's like you care about two things with insurance companies, right? So the type of underwriting they're doing and how they're doing that. And then who's at the helm, when it comes to capital allocation.
Right.
So it's like, how do you judge an insurance company like in today, like at the present? How do you judge the capital allocator when it comes to that?
I can't think of examples where I've liked the capital allocation really in the way of like Berkshire. It's either sometimes it's very safe, which is fine, and then they can focus on the underwriting when success with that. They can get okay returns. You get the returns of the market. I wouldn't expect returns different from that. Berkshire's a very rare example where, you had an insurance company that made money that beat the market. That's very hard to do because of the way that a culture at an insurance company works. There's a temptation to report earnings and to own bonds when you maybe shouldn't necessarily own as many bonds as you do. There's a temptation to pay out too much money in dividends early on. I've kind of talked about that. I mean, you should really not decide on a dividend payout ratio or something like that based on what investors expect. You should decide on it based on your financial strength and how that helps your insurance business. So if it would help you to have a higher rating and to have more capital and surplus and things like that, then probably you want to be building it up. And then at another time, you might be wanting to pay out special dividends and things like that. And a lot of times they don't. They pay more regular dividends, which aren't necessarily the most helpful thing. And they don't get their rating up as high as it should be early on. And then they may not pay out as much as they should later because they target certain growth rates and payments. And, a lot of times they'll even say our investors like that we pay dividends and things like that. And, but it's the same thing as a bank. Most banks pay regular dividends that people like, and that's fine if growth is very predictable. Banks are more predictable than in any given year. Banks are more predictable than most insurers are going to be. So insurers probably would benefit more from like paying out special dividends and things like that. How Buffett did it is he built up capital at times, and then he would make a really big bet, right? So he would let things sit idle, and then he'd do really big deals. That's always hard for people to see and be okay with. The Berkshire's kind of the only company I can think of where they investors stand by and don't mind that and know he'll eventually do a really big deal. Most companies are going to be bothered that you're holding too much capital, which Berkshire did sometimes. They held a lot of capital, but then they would suddenly do a very big deal. In this early part, they actually, in the 60s, they actually did several big deals in the first few years and pushed their capital pretty hard. Like they borrowed money to buy things and did all that.
How would you judge the reinsurance part of a company or just a reinsurer in general?
Depends. I think I haven't liked reinsurers as much as other people because it's kind of complicated. In some ways, there's low barriers to entry. There's low barriers to additional capital in the industry. It's not really low barriers to entry like you could just start up any random reinsurer, because you do need to have people need to have belief that you will pay under any circumstances. But it is not hard to add capital. And then in theory, it shouldn't be hard to take capital out of the business either. But maybe that doesn't happen as quick as it should. So for a long time, I felt that, it's not that attractive a business. But, Berkshire's big, a lot of its big part in reinsurance, cat reinsurance and all that, we're going back like 20 years, not like today. So that's part of it. For Berkshire, I think it was a very successful part of the business, and it's probably the only thing they've started from scratch that was successful. They tried to do lots of other things in insurance. If you look, they started reinsurance and were successful with that. But everything they did with primary insurance stuff, starting it up, for the most part, wasn't that successful. I mean, I think Jacob goes into some of the details there. But they started a lot of companies that lost money and then eventually were shut down, that never really grew into much of anything. If you compare that to how National Indemnity did and how reinsurance did, they were a lot more successful with that. So I think, and reinsurance really took off when they added Ajit Jain, But even before then, they were doing stuff with reinsurance as an idea of what to do. The very first reinsurance stuff was just to add to the amount of underwriting that National Indemnity could do by taking reinsurance on their own primary insurance stuff that they were doing. Then you could have a separate subsidiary do that. And you see that with some other companies sometimes. Berkshire was doing it because the overall company had so much capital versus National Indemnity. So that was a way of doing it. But then eventually they did reinsurance for other people.
Yeah, a lot of people always ask about Progressive because you have the report on the company, and we've talked about it a bit on the podcast.
Yeah. So Progressive is similar to Geico and has some similarity to National Indemnity. Progressive takes very little investment risk. It takes a lot of underwriting risk. So it's very similar to like what you have to watch out for is what happened to Geico in the 70s where things fell apart. It pushes its capital very hard, right? So it writes a lot of premiums versus the amount of surplus that it has on a statutory basis, or if you want to call that tangible shareholders' equity or something on a GAAP basis. And what that means is you're writing several dollars of premiums for per dollar of equity you have, for example. Then also because your expenses are so low, the potential losses, the losses you expect, I should say, are already very high. So let's say you have a loss ratio of like 70% or something, right?
Okay.
As an insurer. So that means you expect that you could lose 70 cents of every dollar that you write.
Yeah.
Okay. Compare that to title insurance that we were talking about. It's really reversed. 70 cents of every dollar is what you're paying out in commissions right away. So actually your losses are expected to be very low. It's mostly a operating expenses kind of business. Anyway, so something like car insurance, when done directly, can have very low expense ratios, but means that your loss ratio could be high. So let's say it's 70 cents. So 70 cents per dollar is what you expect to lose. Okay. Now, if you're writing $3 of premiums for every $1 of equity, right? Then what we're talking about is your gain or loss is going to depend a lot on a matter of what you're able to achieve in terms of that loss rate that you have. So you could lose. So let's say that you're able to, Progressive targets a 96 combined ratio. So 96 combined ratio would mean you make 4 cents per dollar. Okay, 4 cents per dollar you write 3 times premiums to the amount of equity that you have. That's 12% return on equity pre-tax before any investment results. Then you get your investment results and stuff like that. So that's what you're targeting right away. That's many years you have better than that. Some years you have worse than that. But when you think about the loss ratio, let's say, if it is a number as high as like 70, and it can be higher than that, that's what you expect to have. And what I mean by that is, let's say that you have in the case of like Progressive or something, if you're targeting a 96 combined ratio and it's a combination of 26 expense ratio, 70 loss ratio, the loss is a very big component of it. So now, if you think about it, a 10% miscalculation on the loss ratio it turns out to be 10% higher than you expected. It means that's 77% of your premiums.
Mm-hmm.
77% of your premiums now has you writing at a combined ratio of 103, which is a loss of 12% of your equity. Now you have investment stuff that are offsetting that, but you're going to lose book value just from doing that. So just a 10% miscalculation can start to cause losses. With a large diversified amount of auto insurance, I don't know that it's a huge problem. You're not adding that many new customers each year. So a lot of your losses relate to business you've already written before and are just renewing. You can, it's not very long tail stuff. You realize the losses pretty fast within a couple of years, most of them. And you can renew it pretty quickly, change the renewals, like on a 6-month basis. So it's not the most dangerous stuff to write. And think companies like Progressive and Geico have a lot of experience with it. Still, if you grow that business very fast, you can see that the margin of safety is small, right? When you have high loss ratios and you have a lot of premiums relative to equity, you can run into problems really fast. And there's a chapter in the book about Geico and explains how serious it got. And a big part of that is the regulators allowed them to write at a very high amount of premiums relative to equity. Most insurers don't write at anything like that. Some of the insurers we've talked about, like investor title insurance, like some things I've invested in the past and whatever, write at like 1 or 2 times premiums to equity. Geico going into their crisis was writing at like 6, something like that. So that those compound in a big way, those errors, if you have them. But of course, if you have good years, then you don't have a problem that way. And Geico was able to get out of it by trimming back the problem areas. That's the advantage of having a really low expense ratio, which is, more of there's not much you can do about having an expense ratio that's too high.
I was going to say, do you think about insurance kind of the same way that you think about banking, where there's a lot of cost efficiencies and stuff like that goes a very long way?
Yeah, there's a lot of similarities that way. And the problem with banking and insurance both is you got the expense ratio. And so there's kind of 2 ways of doing things. Well, 3. 1, you could never have the expense in the first place, which is the best. And those companies that are born that way and just avoid all those expenses. 2 is you could always be focused on cutting expenses, right? But 3, the temptation always is, well, there are economies of scale. So when someone comes to you, your department, and says, well, we really need to get this expense ratio, we need to be more efficient, one way of thinking of it is, well, if we wrote twice as much business using the same amount of employees, it would be a lot cheaper. And that makes sense and it works. But that assumption is often you can come up with when you ask for a presentation on that, the presentation will manage to show that the quality of the new business you're going to write is the same as the business you're writing already, which seems unlikely because it's marginal business. You're adding to it in any business. When you say, okay, we're going to add another thing, then whatever you add tends to be of lower quality than what you already have. Otherwise, why wouldn't you be doing it now? And that is true in banking, right? So like if as a group, all banks lend to some people who aren't in homes now, mortgages, then on average, the pool of all mortgages must be a little bit worse off from that. Same sort of thing with insurance. And so that's the temptation, right? And the logic of when I mentioned the Progressive thing, their logic makes a lot of sense. Targeting a combined ratio combined with growth. And Geico's done stuff similar to this. It is very good for Geico and Progressive and companies like that to grow. You want to do that. But you have to be very careful. They are growth companies, and they're successful now because they grew a lot in the past. But they have to be careful about their combined ratio stuff, because with companies that aren't in financial services, there's a lot of stuff in the real world that determines how fast you can grow. So, I mean, you can get away with more and more financial engineering. You can franchise things, you can lease things, you can whatever. But a lot of companies, you actually have to make more product. You actually have to sell more product. And so there's a lot of stuff that slows you down as you go out and expand. Most businesses work that way. You're not going to overexpand a series of car dealerships or something because there's so much capital involved in it. But with insurance and banking, to a significant extent, you can basically do as much business this year as you are willing to do.
Yeah, just printing more paper,
Yeah,
getting more autographs.
there'll be demand at some price level, right?
Mhm.
So at some level, I mean, auto insurance is a little different. There's going to be, it's pretty, you're going to take business from each other because everyone wants just one policy and they have to have the policy. But in general, you know, if rates are lower, let's take banking, right? If rates are lower, there actually will be more borrowing and more activity than there otherwise would be, backed by borrowing. If insurance stuff, if you didn't provide insurance for SPACs, there'd be less SPACs. I mean, you're actually having an effect on the real world that way by doing that, but it's just by your promise of whether you will stand by this or not. So because of that, it's important that these can be growth companies, but they have to severely limit their growth and be careful about it. And they are really growth companies. I mean, we talked about Investors Title Insurance, which is still borderline microcap, right? Okay.
It's like 200
That
million.
company's been public for more than 30 years. I think, yeah. So 30 years ago, they were writing, I think, $9 million in premiums or less than that. They've grown at 11% a year for 30 years. And that's with paying some dividends sometimes or buying back some stock sometimes, things like that. So, and not really adding to the amount of equity they have from new raises or anything. So it gives you an idea. You can grow for a very long time that way. You can grow for decades at about 10% a year. Be a growth company in a sense. But it's harder to do the 20-some% growth. And we talked about that with Geico, right? You were amazed at Geico's growth over a very long period of time, but it didn't necessarily have extremely high growth for a period of a year or two.
What was it? It was 15% compounded over whatever it was.
Yeah. And a lot of that is because you retain all the business, right?
Mm-hmm.
For a lot of those, for things like Geico.
Yeah, you've talked about that before, how sometimes companies, they start to really grow fast, but then when you kind of look under the hood, they were almost like buying business in a way because they cut their, prices so much or something along those lines. So it's like, how do you handicap that? How do you judge the growth of an insurance company?
You try to see if they can keep their combined ratio on average at a similar level. I think it's not a good sign if growth is speeding up at the same time the combined ratio is going up. I don't like to see that. You can usually do things to figure out the number of policies they have versus premiums to get some idea of pricing. It's not a great idea of pricing, but it's some idea. If they're in not that many different lines of business, it could be helpful that it actually indicates stuff. We talked about Universal. They were adding the same number of policies each year while revenues weren't really going up as fast as policy numbers. Or were going up at the same, I should say. So that meant that there weren't really pricing increases. That matters because if I look back 10 years, inflation is at least 2% a year. And I could guess that things like what was the value of homes was probably even higher, right? What was the likely amount of legal expenses and things, probably higher than inflation, guess those things. And yet here we have a company that had been adding with lower than the rate of inflation, right? So if it's showing policies up 10% a year at the same time as saying revenues up 10% a year, well then there's not really price increases. And you'd want to see price increases over a long period of time that at least are tracking inflation if you think it's a kind of business that's becoming likely that you'll have even bigger payouts, right? But like individual years, it's a different story. That's a weather related thing. So if I had seen losses for individual years, that wouldn't necessarily bother me. Even with a company like that, if it could have 3 bad years in a row, and some people that would be very scary, saying like, okay, you had 3 combined ratios of 100 something. But if it's a weather event, Berkshire did cat reinsurance, that's going to happen. But that's different from a trend that's going to keep happening, and it's very different from something that you ignored, a trend that was happening that you ignored. That's if you look at Berkshire's other insurance things, which are mentioned in this book and what they tried to do, their urban auto and things like that, some stuff that went badly, workers' comp they did. You can see that there's more trend stuff that are problems. A lot of it is more misjudgment of people involved who are selling your product, misjudgment of the people running the insurance companies, and misjudgment of the customers, misjudgment of brokers in some cases, and misjudgment of the customers that you're that are taking out these policies, that you misjudge the kinds of risks that they are. in their life and financial risks that they're taking and all of that. It's it's writing stuff that's effectively like subprime lending and thinking that it's the same as the business you did before that was like prime stuff. It's the same thing here. That's what happened to Geico. They were writing preferred risk, and then they moved into writing for everybody, and so it's a different population.
Got it. Cool. National Indemnity, one of the most important acquisitions that Berkshire made, 1967. He was also, if you listen to this point in Buffett's life in the snowball too, this was the point of his life where I think Susie thought he would slow down. His net worth was, I think she said, once his net worth gets to 10 million, that he'll pull back a little bit more. Mm-hmm. So I think his net worth was around there, 9 to 10 million at this point, which, by the way, inflation adjusted is about $71 million.
Okay.
And he did not pull back. So I thought it was interesting. It's one of my favorite parts in the snowball. 1967.
Yeah, and it was able to grow a lot. And if you see, Jacob does a breakdown of points of like where the assets were, where the earnings were coming from. Within the first few years, they shift dramatically from textiles to insurance because of selling off some inventories and stuff at the textile mills, but also buying National Indemnity. That made a big shift in capital allocation, and they furthered that shift. But within a couple of years of taking it over, he made a really big shift.
Crazy. Well, I want to thank everybody so much for tuning in with Geoff and I here today on the Focus Compounding Podcast. Make sure you check out all of our content. Go to focuscompounding.com for stock ideas. Follow me on Twitter at FocusCompound, and be sure to hit that subscribe button both on the podcast side of things and YouTube. People were commenting on my consistency for the intros. When I say like welcome.
Yes,
isn't that funny?
Some people don't like that it's too consistent.
No, I think they do like it. I mean, I hope when people are listening, they're saying welcome with me.
Okay. We had some complaints that you don't have to do it every time.
What's that?
I said we had some complaints you don't have to do it every time.
Oh, yeah, you're right. And I said I'm consistent.
Yeah.
That's true. I do remember that.
I don't know why it's a benefit to mix it up every time, but
no, I am consistent. Well, thank everybody so much for tuning in with the both of us. Hit that subscribe button. Check out Jacob's book. I'm going to put the link in the description. Capital Allocation, Jacob McDonough. Follow him on Twitter as well. I'll put his handle in the description too. Thank you so much. We'll see you next podcast. Take care.